Investing in monthly dividend paying ETFs has become sort of a trend recently, but it makes sense because there are a few out there that are really solid investments that produce low risk monthly income. And on this channel, we've talked quite a bit about JEPI and JEPQ, the two JP Morgan covered call ETFs. But there's another very similar covered call ETF that pays out a pretty high monthly dividend and was recently launched within the last year called SPYI. And some would even argue that it's an even better investment than JEPI, but that can definitely be up to you to decide as you watch till the end of this video. So SPYI is very similar and comparable to JEPI, but it's not the exact same type of fund. According to the website, the NEOS S&P 500 High Income ETF seeks to generate high monthly income in a tax-efficient manner with the potential for equity appreciation in rising markets. And then according to the fund's prospectus, it says that it seeks to generate high income from the premiums earned from the SPY call options, as well as the dividends received from the fund's equity holdings. So this means that when you own shares of this fund, the cash dividends that you're receiving each month are both from the companies that are in the fund's portfolio that just regularly pay out dividends, as well as the options premiums on the SPY calls that the managers of the ETF are trading. And that explains why the monthly distribution yield stays relatively high. And speaking of the dividend yield, it's currently at about 12.3%, beating out JEPI's current yield of 8.48%. Taking a look at its distribution so far, it's paid out a dividend every single month since the beginning of this year at an average price of about 48 cents per share. This means that if you were to have put $10,000 into SPYI at the beginning of this year, you'd be averaging about $115 a month just in dividend payments. But as we know, those distributions are variable, so those numbers could be higher or lower than the previous month's payout. It's also more tax efficient than other funds, and I don't want to get too much into the weeds as to why, but basically if you're a shareholder of SPYI, you're taxed on both long-term and short-term capital gains compared to being taxed on only short-term capital gains with funds like JEPI. And the fund managers also take advantage of tax loss harvesting as well. So you're saving a little bit more come tax season when investing in SPYI compared to other similar ETFs. So now that we know that SPYI and JEPI are two completely different covered call ETFs, but still have their similarities, let's now compare the two a little bit more. When it comes to expenses, JEPI has a slightly lower expense ratio of 0.35% compared to a fairly high expense ratio of 0.68% for SPYI. And for those of you who don't know, this means you'll be charged $68 a year for every $10,000 invested into SPYI as a fee for owning the fund and reaping the rewards that come with it. And to be completely honest, when it comes to the expense ratio, in my opinion, it's not really something to worry about too much, especially if it's less than 1% and you're getting those high monthly dividend payments anyway. The dividend yield is obviously going to offset that expense ratio, so it's not really something to be obsessing over, but definitely something to keep in mind when investing in ETFs. When it comes to the performance of these two funds, SPYI has just been crushing it so far this year, being up about 14%, with JEPI trailing behind at only 5% year to date, including dividends. And both these funds do have exposure to capital appreciation when the market is trending up, but it looks like SPYI grows a lot more significantly when the market is positive, especially as the market has been recently rallying. So really up to you to decide whether or not you think SPYI is a better income play than JEPI. I think the biggest takeaway when comparing these two funds is that JEPI has a lot more solid of a track record. It's been paying out monthly dividends for the past 3 years now, with each amount being fairly consistent month over month, giving it a 3-year total return of about 45%, which is still really impressive. Whereas SPYI has only been paying out its dividends since the beginning of this year, like we just saw. But there's nothing wrong with having both these ETFs in your portfolio to complement each other, especially if you're an investor focused on dividend income. But let me know in the comments below if this is an ETF you'd consider adding to your portfolio for that high monthly income and tax efficiency, or if you're sticking with other investments for now. As always, guys, feel free to leave a like on this video if you enjoy this type of content, and I'll catch you next time. See ya!